The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone.
Good afternoon.
Welcome to the AVPN August webinar on Sustainable Finance Initiative and Robeco's active ownership. My name is Olivia, and I'm the Senior Associate of Greater China at the Asian Venture Philanthropy Network. AVPN is a unique founders network committed to building a high-impact philanthropy and social investment community across Asia. Currently, we have over 500 members across 32 countries, and we are very pleased to have a few of our members based in Hong Kong speaking today. In this webinar, we will hear from Sustainable Finance Initiative, a project led by AVPN member RS Group. Representing Sustainable Finance Initiative, we have Leonie Kelly and Tze-Wei. Leonie and Tze-Wei will discuss why sustainable finance is relevant to investors and the dimensions of sustainable finance. They will also share insights from their latest market research mapping sustainable finance in Hong Kong. Following that, we have Ronnie Lim and Peter van der Werf, Senior Investment Specialists from Robeco's Active Ownership. Ronnie and Peter will share about ESG integration in global fundamental equities, credits, and quant funds. They will also walk us through how active ownership adds value to investments. So before we proceed, a few housekeeping instructions. We will not take any questions during the presentation, but we'll open up the floor for Q&A afterwards. Please feel free to use the console to type in your questions during the webinar, and I will raise the questions to our speakers. If you have further questions that are not answered by the end of the webinar, you can email us at china@avpn.asia. Without further ado, I will now hand over the presentation to Leonie and Tze-Wei.
Thank you, Olivia. And it's fantastic and wide reach today of listeners on the webinar. As Olivia has outlined, the Sustainable Finance Initiative will be discussing our story and our mission, what exactly we mean by sustainable finance. We'll also be sharing our insights into our research, which set out to map the state of play of sustainable finance in Hong Kong. We'll then look towards more recent market developments we've seen happening here in Hong Kong and internationally, and finally close on our offering. So where did it all begin? Really, the story of the Sustainable Finance Initiative very much began with Annie Chen, the founder and principal of RS Group, asking this question: what is the purpose of wealth, and why her investments were not aligned with her values? For those of you who don't know RS Group is a Hong Kong-based family office whose aim is to create a paradigm shift in our societal values and our priorities so that economic growth does not jeopardize human development and environmental sustainability. In 2008, Annie and the team embarked on a journey to transition her whole portfolio into a sustainable one. Firstly, by screening out investments that were harmful to the environment or society, and then gradually moving on to investments that created positive social and environmental impact. Very much inspired by the concept of blended value, a term coined and developed by Jed Emerson, which refers to an emerging conceptual framework in which NGOs, businesses, investments are evaluated based on their ability to generate and blend financial, social, and environmental value. In 2015, the team achieved 100% mission-aligned total portfolio. Fundamentally, that means they achieved a portfolio which achieves social and environmental impact across investment and philanthropy. In 2016, the team went on to share a public impact report and began to actively advocate by sharing the challenges faced, the mistakes made, and the lessons learned on the sustainable finance journey. Through engagement with the broader sustainable ecosystem here in Hong Kong and internationally, and throughout their own journey of transitioning the portfolio, the team recognized there was a need to create very much a dedicated platform to do advocacy work in a more structured way, hence the birth of the Sustainable Finance Initiative Hong Kong. Now, why are we doing this? Well, in 2017 in Hong Kong, we recorded the widest wealth gap in history, with the richest household earning 44 times more than the poorest family. 1 in 7 Hong Kongers are living in poverty today, with 1 in 3 of our elderly struggling to survive. As inequality worsens across the globe and crisis after crisis hits the financial sector, it has become clear that our current financial system and growth model is simply inefficient, weak, and driven by capitalistic values that simply do not serve the needs of the real economy and society as a whole. Fortunately, there is a growing global momentum to align the financial system with sustainable development, one that does not sacrifice tomorrow for today. It is estimated that between 4 to 7 trillion US dollars of annual investment is required to meet the United Nations Sustainable Development Goals, and the current funding gap is about 2.5 trillion US dollars per year. The role of private capital was highlighted within the Paris Agreement, which set out and aims to keep global temperatures from rising above 2 degrees Celsius. And it was also highlighted by the United Nations Sustainable Development Goals, which sets out 17 goals for all countries to end all forms of poverty, fight inequality, and tackle climate change by 2030. We believe private capital can play and will play an important role within this transition, as philanthropy and public investment alone will be not enough to fill the funding gap. This is where the Sustainable Finance Initiative comes in. Now, what is our mission? Quite simply, it is to unlock and mobilize private capital for impact. And it's also to help accelerate Hong Kong's transition towards becoming a sustainable finance hub. Why have we started with private investors? Well, we start with private investors not only because of our own journey, having transitioned the portfolio at RS Group, but we fundamentally and strongly believe the large percentage of private investors here in Hong Kong will trigger market growth in the broader sustainable finance economy. We believe by sharing RS Group's journey in a more structured and dedicated way will hopefully help shorten the time that other investors would otherwise have spent starting their own sustainable finance journey. So SFI is setting out to build a community of private investors who fundamentally believe that capital matters. They are investors who want to learn, connect, and take action and be leaders in sustainable finance. What is our approach at SFI towards sustainable finance? Well, sustainable finance is an umbrella term referring to an investment strategy or financial service integrating environmental and social governance criteria into the business or investment decisions for the lasting benefit of investors and society at large. Quite simply, it's simply smart investing. At SFI, we use an inclusive definition of sustainable finance. We draw no distinction between responsible investment or sustainable investment or social responsible investment. The sustainable spectrum maps out a range of risk-return strategies that investors can adopt, with traditional investments on the left-hand side of this graph and traditional philanthropy on the right-hand side of this graph. Depending investors' desired risk and return and impact profile will determine where that investor wishes to play across the spectrum. But more importantly, at SFI, we believe impact is very much in the eye of the beholder. Some investors may want to focus on environmental or societal solutions that generate market rate financial returns. Other investors are willing to make investments whose impact thesis may or may not deliver a market rate financial return. And finally, others are willing to make investment whose impact approach requires a trade-off of financial return in the short term. Strategies for sustainable finance can be located across this spectrum, and these strategies include exclusions, ESG integration and engagement, thematic investing, and impact investing. Later on, Robeco will go through ESG integration and advocacy engagement. Moving on from our approach to sustainable finance initiative, I want to briefly introduce the state of play mapping research report that Sustainable Finance conducted earlier this year. In 2017, SFI began mapping the state of play of where was the ecosystem with regards to sustainable finance. We wanted to identify the challenges, motivations, and barriers to growth across 6 key stakeholder groups. I'll now pass to Tze-Wei, my colleague, who will take us through some of the key findings from that research.
Thank you, Leonie. Over the course of 2017, SFI conducted the first of its kind market survey to review the state of play of sustainable finance in Hong Kong. We approached nearly 690 market participants with a role in transitioning Hong Kong towards a sustainable finance hub, and we had an encouraging 35% response rate with participation from 239 stakeholders. They represent the 6 stakeholder groups here on this page: investors, academics and researchers, financial service providers, professional service intermediaries, corporates, and government and regulators. Of the respondents, 51% were of senior executive level. And now, let me take you through some of the key findings from our survey. First and foremost, our stakeholders firmly believe that sustainable finance is key to Hong Kong's competitiveness as a financial hub, and that Hong Kong should lead and not follow. In the past decade, we note that there is a change in mindset globally towards sustainability and the role the financial system can play, with major capital markets establishing a strong position in this sector. Governments have made sustainable finance a major policy focus in several countries, including China, Japan, Indonesia, and Singapore in this region alone. When we conducted our survey, a staggering 90% of respondents believe that Hong Kong is behind or reactive in terms of sustainable finance compared with other global jurisdictions. The good news is, Hong Kong announced the issuance of its first and the world's biggest sovereign green bond earlier this year in March. We are encouraged by this latest development and see this as a positive signal that Hong Kong is showing its ambition to lead in green finance. But we also believe that there are more opportunities to explore beyond green bonds and green finance. As our stakeholders indicated, 75% of them believe that sustainable finance is critical in order to maintain Hong Kong's primacy as a leading international financial hub. We are definitely hoping to see more commitment from the Hong Kong government to grow sustainable finance. Key finding number 2. When we set about trying to understand the key challenges inhibiting growth for sustainable finance in Hong Kong, our stakeholders noted 3 top challenges. The greatest challenge of all is the lack of market awareness and understanding of sustainable finance. Of the 75% who indicated they were interested in sustainable finance but unsure on how to begin, they cited this as the greatest challenge to market uptake. The second top challenge is the perceived concessionary financial return. This finding is also in line with what we see in other international markets, but seems to be a particularly pronounced challenge within Asia. The third top challenge is the lack of enabling government policies and regulations that promote sustainable finance. But as we noted earlier on, this is an aspect we are hoping to see more positive development soon. Key finding number 3. When we ask stakeholders what they think are the key catalysts to promote growth of sustainable finance in Hong Kong, these are the top 3 market catalysts identified: the growing of investor demand, the development of a supportive policy environment through incentives, subsidies, and regulations, and the expanding of fiduciary duties with respect to ESG. So who will be key to bringing about these changes? Over 60% identified the top 3 stakeholder groups most important to promoting sustainable finance in Hong Kong as asset managers, government, and asset owners, which probably apply to many of us in this call, on this call here today. Finally, after identifying the top challenges and market catalysts we want to see, our 4th key finding is this. Our survey shows that Hong Kong stakeholders are ready to get active. About 77% of the respondents were already active in sustainable finance, and 90% of them wish to maintain their current activity levels or become more active. And it is also not just about getting active. Over 30% want to become leaders in the industry. If we break down the data along the line of gender and generation, we note further that women and millennials show greater interest in becoming leaders than their counterparts. These two trends that are in line with many global findings provide exciting opportunities for engagement as we try to grow the sector. The above survey spoke across stakeholders group in Hong Kong. What about the private investors specifically? As we continue to engage with the private investors, we have learned more of their needs. For example, they tell us that they need both technical knowledge and soft skills. Soft skills such as how to engage the asset managers and bring their family members along on this journey. They want to see more sustainable finance professionals. They want to learn more about strategies that can help them blend giving and investment, which is pretty much practiced in a bifurcated way in Hong Kong right now. They want greater access to deals and entrepreneurs. And finally, in line with other international studies, they also want to see more case studies showcasing that investors don't necessarily have to forego financial return for impact. But our investors also firmly believe that sustainable investing is no longer an option, it's an imperative. The visible impact of human activities on the natural environment, from habitat loss to pollution to climate change, have driven this change in mindset. They also believe that the financial system can be harnessed as an engine in our economy's transition towards sustainable development. We should continue to develop in a manner that meets the needs of the present without compromising the ability of future generations to meet their own needs. So all in all, our findings from the survey and ongoing engagement with private investors is this. Sustainable finance is at a critical juncture in Hong Kong. We are falling behind on the green race on one hand, but our stakeholders also recognize the urgency and are ready to become leaders in the industry. We have a window of opportunity now. So let me now pass it back to Leonie, who will guide us through some of the recent market developments.
So we've heard earlier sustainable finance will very much be a key driver of future competitiveness in the financial markets. So aside from our own research that we've done, and we've just learned about mapping the state of play of sustainable finance in Hong Kong, more and more data has been released by other institutions, banks in Asia. We'll draw out one example here. So Standard Chartered earlier this year released a report called Asia Sustainable Investing Review. And this report, which was released a few months back, findings are very much in line with our own research findings. Having surveyed over 400 private investors, the survey identified quite a significant knowledge gap amongst private investors on the opportunity within sustainable finance. The survey also found that while sustainable investment currently makes up less than 20% of total investment portfolio of active investors, that the share is likely to grow up to 3% over the next 3 years. And looking then amongst their investors who are giving through donations and philanthropic work, among that 50%, over 80% are willing to consider shifting their allocation towards sustainable investing strategies. And one of the other common findings between the Standard Chartered and other research that we've seen coming out alongside our own is that private investors are looking to see case studies around the demonstrated track record of positive financial returns, which is also very much in line with the a key challenge that our own stakeholders identified or have a concern about the perceived concessionary financial return when becoming active within the sustainable finance market. So stepping away now from the research market developments that we've seen, we also just wanted to put a spotlight on why we believe private investors are critical and important to growing and unlocking capital and directing that towards sustainable finance in Hong Kong. And we only have to look at a recent report released earlier this year by the Securities and Futures Commission Hong Kong. Within that report, the Security and Futures Commission report was called Asset and Wealth Management Activities. One of the major findings is that assets under management reached over 24 trillion Hong Kong dollars at the end of 2017, with the share of private banking and wealth management assets amounting to 7.8 trillion Hong Kong dollars. That represents 32% of assets under management in Hong Kong within private banking and wealth management assets. Now, why does this matter for sustainable finance in Hong Kong? Well, the number of wealthy individuals in Hong Kong is at an all-time historic high. Hong Kong had 1 million millionaires last year. That's up 15% from a year earlier. That's not all. Hong Kong just added more billionaires than any other major city in 2017, bringing its total count to 93, just 10 less than the leading city, New York. So we believe that by growing private investor demand and the private investor base, that private investors can play a pivotal role in supporting the growth of sustainable finance in Hong Kong and transitioning Hong Kong to being a sustainable finance hub. But more education, knowledge building and products will be needed and need to come to market quickly to facilitate this capital flow. So private investors will also have a significant role to play in also pushing Hong Kong listed firms on the Hong Kong Stock Exchange, for example. So we found this year, although the disclosure standards have become more stringent, we also found only 38% actually of 400 listed firms on the Hong Kong Stock Exchange complied with all 11 environmental and social governance aspects. This is a report that's been released by the Hong Kong Stock Exchange in May of this year. So why is this important again? So we believe that private investors very much have a role here to support and engage these corporates to advocate for and push more stringent compliance with the ESG disclosure standards, so that it is not simply just seen as a tick boxing exercise, but that corporates can start to see that investors place value in these ESG reports. And finally, looking at the broader policy environment in Hong Kong, we've heard earlier the Hong Kong green bond issuance is very much a positive signal to regional and international financial markets. But another sign of market maturation will be the development of specialized investment institutions, for example, in Hong Kong, such as green banks, further fiscal and financial policy support, such as green loans, further development of green bonds, strengthening the financial infrastructure, such as green ratings, development of green stock indices, further green investor networks, and looking beyond green and looking at sustainable, trying to emphasize the social as well as the environmental outcomes within the networks as well. And one other area we believe that is needed to grow and develop in Hong Kong will be the legal infrastructure, such as green insurance, and also identifying and clarifying environmental and social liabilities of banks.
So to address the gaps identified in our survey and ongoing engagement with private investors, and in responding to recent market developments, SFI has decided to focus on building a community of active private investors through 3 pillars of work: to educate, demonstrate, and connect. We aim to curate content through workshops and our online platform that will help share knowledge and spark conversations necessary for private investors in Hong Kong to get active. We also hope to demonstrate to private investors that one can do good and do well through a pilot investor circle, bringing together a small group of investors who are ready to get active and start investing in deals together. And we also will be implementing activities that bring together the private investor community in Hong Kong, emphasizing peer-to-peer learning and the forging of a collective informed voice on the growth of sustainable finance in Hong Kong through public speaking and op-ed opportunities. As we have heard at the beginning of this presentation, the financial system we rely upon is weak, and we need to improve it to better serve the needs of the real economy, the society, and our environment. Sustainable finance is a way to help us achieve that goal. As a major international financial hub, Hong Kong needs to be part of this transition to sustainable finance, and is in fact uniquely positioned to be a leader. With its well-established legal, accounting, and financial infrastructure, international connectivity, and talent pool of professionals, Hong Kong can facilitate the flow of capital required to help achieve sustainable development, both locally and globally. Success for SFI is to see more products, deals, research, and policies that support the growth of sustainable finance in Hong Kong, and to see sustainable and impact investing becoming mainstream. We look forward to working with you all to achieve this goal. And we would like to end with a quote from Annie. No matter how much or how little wealth we own, we are all investors in some way, whether it is via our pension, the stocks we buy, or simply where we choose to spend our money. If we can all be more aware of how our money is spent and deployed, change will naturally take place. And now we'll pass to our co-presenters from Robeco, who will speak about how to apply sustainability in your portfolio as a private investor.
Hi, thanks very much for that. Sorry, Peter, did you want to go ahead?
Yeah, well, thank you all for joining us and giving us the opportunity to present. My name is Peter van der Werf. I'm a Senior Engagement Specialist for Robeco, based in Rotterdam in the Netherlands. And I will co-present with my colleague Ronnie Lim, who is also a Senior Engagement Specialist, who is based in our Hong Kong office and is collaborating very closely with our Asia Pacific investment team, which is based there. So when we got the invitation to present here, we looked at the question of how to apply sustainability in your portfolio as a high net worth individual, and we've taken the liberty to set up a presentation in which we will quickly run through some of the different strategies which we have and how ESG integration is applied there, to give you a bit of background how sustainability has its place in all these different strategies within different asset classes. And we'll spend most of our time speaking on active ownership, which is the activities which both myself and Ronnie on a day-to-day basis take care of, and which are an important element of our ESG integration strategy at Robeco.
Okay, thanks very much for that, Peter. I also want to take this opportunity to thank the Sustainable Finance Initiative and the RS Group for making this attempt to try and close that knowledge gap which exists in Hong Kong. And I hope that Peter and I today can make some contribution to addressing that gap. I'd like to move to the slide here. As you see on page 23, the message here really is that Robeco and Robeco Sam are partners in sustainability investing, and we have together had over 23 years of experience as companies in sustainability investing. Just to give you some context of that, of the Robeco, who don't already know us, we manage $185 billion US across equities, credits, and other strategies, and about 70% at least of that assets are managed in what we call in a sustainable way, or ESG integration included in that. I won't spend too much time on the high level stuff, but just to sort of give you some meat as to how we actually work together. So essentially, it's very important as an asset manager, working in this space, and we are a mainstream asset manager primarily. Robeco Sam, based in Zurich, does have some niche sustainability theme funds, for example, like water funds, but essentially the process starts with the orange box you see on the right here, sustainability investment research. We have a team of about 15 sustainability analysts based primarily in Switzerland, but also elsewhere. At Robeco Sam have been focusing on what we call financially material ESG issues since 1995. The emphasis here is that why we mention financially material is because sustainability is such a holistic and wide topic, but for an active investment manager, we feel it's extremely important to try and narrow some of these issues down to what we feel are financially material. Not because the other issues are not important, but simply because this is where we feel we can be most effective in research, most effective in impacting our portfolio decisions, and also most effective in our active ownership or engagement with companies. The second box at the bottom, portfolio management. This research is then integrated with other forms of research in our portfolios, in funds managed not just by Robeco Sam, but also across Robeco. We can go into some further detail a little later about how specifically that research is integrated with environment, with equities and credits as well. So this starts from essentially a proprietary analysis of around 4,000 companies by Robeco Sam, and it covers these three primary areas of social, governance, and environmental dimensions. This visual, if you just go back one slide, hold on, I'm just going to go back one slide here. This visual just essentially shows that on the black line here, that's a sustainability profile of a European benchmark of equities or stocks. And for a sustainable portfolio, the green bar on the outside shows that the performance of a European equity portfolio managed on a more sustainable basis. So it's a simple visual to show where that portfolio can deliver enhanced sustainability performance. I'll then move on to briefly how we integrate ESG into fundamental equities globally. So essentially, an investment philosophy is shared across the different teams, including both the fundamental teams as well as the quantitative teams. And the bottom line is that Robeco in the active fundamental equity teams are very valuation based. It's stock picking based, and it's based on long-term sustainable cash flow generation. The operative words being long-term, because as longer-term investors, our holding periods are longer. We have shorter portfolio turnover, and because we have this investment philosophy, it makes it more logical for the investment teams to then consider longer term dynamics. For example, things like corporate governance, climate change, which typically think as intangible and long term, and that's embedded into the investment process. Move on to the next slide. Hang on, let's have a look. Peter, do you want to hang on a second here? I'm just all right. So just a bit of a delay on the slides. So the integration of financial and sustainability analysis. So we essentially believe that the sustainability dimension of the analysis does improve our security selection. Security could either be an equity or a credit. So this detailed analysis is performed by a combination of our fixed income teams, looking at obviously the credit side of it, and also on the equity side. On the equity side, we are focused on for this slide is a combination. The slide does say upside price potential, but we look at both upside as potential downside price potentials, where we feel ESG considerations could be relevant in terms of impacting a view on a company. So when it's appropriate, we then adjust assumptions on a number of financial drivers, including things like return on invested capital. But obviously, that's obviously more subjective from a risk perspective. But occasionally, we also have obviously very specific ESG drivers or opportunities where we can quantify what the risk is. We have found for global equities that the ESG profiling actually impacted the valuation of roughly about half of listed companies worldwide. And we've also found some evidence, it's only 3 years of data, but some evidence that companies with positive ESG valuation impact actually outperform companies with a negative valuation impact. So that's quite important in terms of trying to quantify something which has historically been very difficult to quantify. The valuation impact we mentioned earlier, roughly this slide just shows you where the impact could be. Roughly about half cases, there is very little impact on valuation, as you would expect, potentially for this analysis. But on average, we found that about 7% of our valuations are attributed to ESG factors. It's quite a big dispersion, and more information is contained in that slide to explain why that might be the case. Now, I'll pass on to my colleague now to talk about ESG and integration in the fixed income or credit analysis space. Peter, over to you.
Yeah, so for our credit analysis, we use what we call the F score, which is basically 5 pillars on business position, corporate strategy, corporate structure, financial profile, and as a last factor, ESG profile of the company. And we'll always look if a credit issuer in relation to other issuers with a similar rating does either better or worse, in our opinion, on one of these 5 pillars. So from that perspective, if we assign a negative score to ESG profile, and I'll show you one case later on in which we did so, then we will need to have more attractive credit spreads to make up for what we deem a higher ESG risk in this credit issuance. So you see that roughly 25%, little less than that, got a negative score. A vast majority of roughly 70% neutral, and only a small percentage, as it is credit analysis, where we are primarily concerned about downside risk. Only a small percentage of roughly 7% has a positive ESG contribution. One of the companies in which that took hold was for Kellogg's, where we saw that based on the high sugar content products which they're selling, and also the little awareness which the company showed in their reporting, and also throughout the engagement which we had earlier on with the company, we assigned a negative score, and therefore for Kellogg's to be part of our credit portfolios, they need to have superior financial returns from a credit perspective in terms of its valuation, for us to take it up in our portfolio, because we want to be compensated for that additional ESG risk, which we think on the medium to long term could pan out if these type of companies are really held accountable for their impact on the global obesity pandemic. This was for us a reason back in 2015 to start an engagement case, and that's, if you remember that circle which Ronnie presented earlier on, where you had sustainability research. So we looked at sort of a peer comparison of all the different companies and their product reformulation strategies. Then our analyst took that on board in how she set up the F score. So she gave a -1, and that was the signal for our active ownership, which was the third circle within that diagram, which is our team to then start engaging with the company with the view of improving their conduct on product reformulation, on innovation, and on their awareness and transparency, with ultimately trying to close that loop, that our investments would ultimately improve, that we could re-rate the company, and therefore also take away some of that ESG risk which we initially identified with our sustainability analysis. If we then move on to the next topic, in our quantitative equity strategies, we obviously don't have fundamental analysts looking at all of the issuers or all of the stocks individually. That's where we use much more of our Robeco SAM scoring methodology to then also identify which companies are most attractive to take up in our portfolio. So if we, from a quantitative ranking perspective, see that companies are equally attractive from a financial perspective, we will always take up the company with the highest sustainability score of those two, and therefore we are able to guarantee that we have a higher than the benchmark sustainability score for the portfolio at large. We then also have a growing number of strategies where we are moving into a more sustainable character of these portfolios, and therefore we're able to now deliver in most of our strategies a sustainable low vol strategy or sustainable global enhanced indexing strategy, and that's really also dependent on the wishes of the client. And this is a slide which shows for a few of those where we then on some of those characteristics differ in terms of, for instance, carbon emissions, water use, energy consumption, where we are 20% better than the benchmark for these sustainable variations. And with that, I would like to move it over to Ronnie to start introducing active ownership.
Thanks, Peter. This slide, just to explain what active ownership is, essentially it's a process of influence. We use our capital as shareholders or as bondholders to engage or speak to the management of essentially public companies to try and influence them to improve their behavior in terms of ESG deliverables. This is a study by a London Business School, which has shown that in terms of engagement, there was quite a substantial abnormal return or excess return for successful engagements over this period using US public companies over a period of 10 years. Even for unsuccessful engagements, importantly, there is shown to be no negative impact there. So from a perspective of an investor who's interested in obviously investing more sustainably, one can begin to think of engagement as something which at the very worst doesn't impact returns negatively, but where successful can result in quite outsized returns. just move to the next slide. This is just a summary of for Robeco, our engagement and voting activities. As you can see, we have Peter sits in Rotterdam with a team of around 11 specialists. I'm based in Hong Kong, but importantly also, apart from the not regular process of voting at shareholder meetings, a lot of the influential discussions go on in private, behind the scenes, by emails, phone calls, company meetings. We also increase our leverage by working closely with relative portfolio managers as well. So this obviously gives much more legitimacy and power to our ability to influence outcomes. This slide just shows us a summary of the team based in Robeco. I wanted to bring to life a little bit more what could be quite a abstract discussion. An example here, we engage with companies globally, obviously, but I've picked up an example here looking at Japanese companies' governance. Now, Japanese corporate governance practices are widely considered to be, Japanese companies are considered to be world-class in most of their consumer goods, certainly their technology, B2B goods, which are sometimes not visible to a consumer, but appear in everything from computers, smartphones, cars. Japanese companies are world leaders, and they're very, very proud of making products which are perfect. Now, where they are suboptimal is their corporate governance, and this is largely an attribution to culture as well. In particular, we found that shareholder value creation is not prioritized. In Hong Kong, for myself personally, spent a lot of my time focused on corporate governance, but very specifically, corporate governance not just from a compliance perspective in terms of best practice, international best practice, but also capital management. So we found in our analysis of around 400 companies in Asia Pacific holdings and about 200 companies in Japan, the average return on equity is very, very low, and about approximately 70% of companies in Japan do not actually deliver a return greater than the cost of capital. For those of you who are not a finance specialist, essentially means that these are all public companies which do not deliver their first or main aim to their owners, which is to deliver a positive return on capital after accounting for risk. So sustainability often can be perceived as just environmental and social issues, and Japanese companies as a whole, being a stakeholder society, they manage social issues pretty well in terms of employees and other stakeholders. They generally are pretty efficient, and both from an environmental perspective and energy perspective. However, if you can do these two things well, but yet not even deliver an adequate return to the owners of the company, we feel this is a major area where we can improve issues here. So moving to a specific company case, ASICS. Sorry, it's a Japanese. Sorry, I'm just moving the slides here a bit. Right, it's those of you who go to the gym or run will know that ASICS is a leading manufacturer of sneakers, sports sneakers, particularly high performance running shoes. So our objective when we started meeting them about 2 years ago initially, as well as with the legal team, primary issue they had a anti-takeover provision in the documents, which meant that it was very, very hard for a hostile company to take over the company and change management behavior. This is a consistent theme across in Japan. Even without the anti-takeover measures, many Japanese companies do not want to change in any way. So it hasn't always been this way in Japan, but certainly in the last 20 to 30 years, the level of risk aversion by companies to make innovative decisions in their businesses have been declining steadily. So we were successful in this on this takeover measures. They made some changes to the mechanism, the policy, which requires a special shareholder meeting to approve the issuance of new shares. So that was quite an important change there. We are still continuing engagement with this company. We've held the company for over 8 years now in our Hong Kong portfolios, but the engagement is now focused very much on capital management at ASICS, which is significantly worse than their peer group, which includes global peers like Nike or Adidas. This is just a brief slide to show an example relevant to a Hong Kong listed company. It's a Chinese company, but Hong Kong listed. It has been taken private. But this is a case I was closely involved with last year. This essential story, or this is one of the first few examples of a hostile situation in Hong Kong. is very, very rare, where a mid-cap company like Inde Gases, again, which we held a long time, there was a change in management which we didn't agree with. We wanted to remove the new CEO and chairman and replace them with the two founders of the company. So that process was very much a collaborative effort between Robeco and other large investors, which began engagement. We then had an intervention here on the slide by Air Products, which is a trade buyer, which wanted to buy the company at a large premium. The new management objected to that bid. They wanted to just retain control. Obviously, as responsible investors, we wanted to ensure that the best value was realized for all minority shareholders. This eventually culminated in an extraordinary general meeting, or EGM, in Zhuhai in China, where we cast our votes together with a collaboration with other investors in order to remove the CEO and chairman. We were ultimately successful in this process. We were, very pleased with that. The company now was subsequently not taken over by a trade buyer, but was bought out by a private equity firm. So this is a case where we closed successfully with the satisfaction of minority shareholders. I'd like to pass this across now to Peter for the next few slides.
Thank you, Ronnie. So as Ronnie is focusing on many of the corporate governance challenges in particularly in Asia, which is his remit, I focus on many of what we call social challenges or social topics, and one of those is sugar, where we see, as I explained, for Kellogg's and also for many of the other consumer packaged goods companies, is that they historically have had a product portfolio in breakfast cereals or in beverages which are extremely high in sugar content, which obviously attract a lot of consumers, which have an enormous impact on the global rise of the obesity pandemic, which has in turn also a huge healthcare cost to society. So as we expect this in the mid to long term really to be put more closely in terms of accountability to these companies, we see this as sort of a what we call an obesity risk overhanging these companies. So therefore we engage with them on topics like product reformulation, product labeling, responsible marketing, and responsible lobbying, we see so far good results from the engagement we have. Companies are aware of that. They struggle with how quickly they can reformulate their products, and we encourage them to especially look at innovation and start bringing new, innovative, much healthier products to market to sort of sway consumers out of their legacy products. And another team which I'm running is sustainability in the meat and fish supply chain. So we see that there is significant risk on the one hand in terms of product quality and safety for companies producing meat and producing fish products, but at the other side there's also social risks such as labor standards for workers, animal welfare, but also the practices used in aquaculture production, which are particularly important for Asia as well. So this is a topic where we've done now engagement for 2 years, and we also see quite a significant shift in consumer awareness among those topics, and which ultimately will obviously influence consumer purchasing decisions, which will in turn impact all of these companies. And then moving to a last case which we wanted to highlight, which is Petrobras. This was a widespread corruption scandal in Brazil, and we had very effective engagement there because our governance specialist was able to basically get a new minority shareholder representative appointed to the board, which was a collective effort with a lot of other global investors. And this is also an important thing to note, is that by collective action, the capital markets, through engagement, are really able to move the needle in terms of getting significant improvements at companies which will improve their sustainability performance, and in this case take away some of the corruption risks where the Brazilian government was really involved. In terms of client-specific solutions, we have, with all of these capabilities which we presented, and also with our active ownership, which is really sort of applied across all the different strategies, we have the flexibility to offer all of these type of solutions, from exclusions, integration, and impact to our client base. So if there's any interest to follow up on that, my colleagues both in Hong Kong but also here in Rotterdam would be happy to speak on that. With that, I would like to close it off so that we, from this perspective, are able to present to you, and answer any of the questions you might have. I believe we have received some questions already through the chat, so I think it would be good to turn out to that.
Okay, thank you to all our speakers, Peter, Ronnie, Leonie, and Tze-Wei. I'm now ready to take questions from the attendees. Please feel free to use the console to type in your questions, and I will direct the questions to the speakers. The first question we have here is for SFI. The question is, are there any concrete initiatives already underway? Will SFI also have an advocacy role with the government?
Thanks, Olivia. So taking that question in terms of the activities and initiatives of SFI. So the Sustainable Finance Initiative, having launched in June of this year, and our strategic focus being primarily on the private investor, we'll be launching our initiatives and activities programmatic work from September on. But to highlight what some of those are, as Tze-Wei, my colleague, mentioned, we are developing a investor circle, which is a peer-to-peer network of a small group of active sustainable finance investors here in Hong Kong who are looking to really become even more active across the sustainable finance spectrum. This peer-to-peer network will fundamentally be developed to show and demonstrate that investors can do good and do well. So it's not simply to increase capital flow and direct those towards different strategies, but it's also to showcase some of the case studies, some of the findings to the broader investor group here in Hong Kong, so that we actually create some sort of trigger effect and unlock market appetite amongst other private investors who may be somewhat thinking about becoming active in sustainable finance. So I would say, in terms of our other programmatic works, please do watch our website, sustainablefinance.hk, where we'll be listing those programmatic works already. Our investor circle has already started, so we'll be sharing those findings as we go on that journey on our website.
Great, thank you, Leonie. The next question is for Robeco. Could you share more on the methodology of qualifying that only 7% of ESG factors impacted stock valuation? What are the implications for SRI strategies given the lower figure?
Yeah, I'd be happy to answer that, and Ronnie can chime in obviously as well. So our methodology looks really at identifying what are what we call value driver adjustments based on ESG factors. So this isn't to say that only 7% of cases ESG factors are important. We think that they are important to analyze in every single investment decision which you make, so in every investment case. However, 7% of the total value which we identified what could be attributed to ESG factors, and the other 93% is based on what we call conventional financial metrics. So those are typically part of the value drivers which we identify for a company, which would then either be expressed in its upside or downside in our investment case. So the 7% is really pointing at specific ESG factors which investors not taking ESG into consideration would have missed in terms of either upside or downside, which are, in our view, important to consider.
Hi, I would just add to that question as well, that answer, sorry, this is a slightly artificial measure in a way, the 7%, because, for example, in the Asian Pacific fundamental equity team here, where the team evaluates a stock for potential investment, and if we look at corporate governance or other environmental social drivers which we believe to be material, that is part of the entire assessment. We don't work out necessarily what company is worth or stock is worth, intrinsic value, and then add on an ESG element to that. It's done as part of a holistic way of looking at the company. So sometimes it's quite artificial to try and separate out the ESG analysis, which can or cannot be material.
Great, thank you so much. The last question for today is probably being addressed to all of you, so any one of you, please feel free to answer. The question is, what about Hong Kong as a gateway for sustainable investment in China? What is the state of the sector in China?
Thank you, Olivia. I think in terms of Hong Kong as a gateway into China, it's especially and particularly important with regards to green finance. So I think Hong Kong has always been the gateway between the Chinese mainland and the rest of the world, very much serving as a preferred location for international investment in the Chinese mainland bond market, as well as for the mainland issuers to raise bond financing. And I think the same applies when it comes down to green bonds. So we've already seen that there's strong demands for green funding from the Chinese mainland and for green investment opportunities from international investors. But very much the green financial flow between the Chinese mainland and the rest of the world has been quite insignificant, and that's due to difference between different financial infrastructure, market practice, legal and regulatory regimes. So Hong Kong is quite well positioned to bridge that gap. And Hong Kong, I should say, has gone some way in this year alone to improve and develop the green certification scheme, which was developed by the Hong Kong Quality Assurance Agency, the HQAA, which actually references a number of widely recognized international and Chinese mainland standards in that certification. And I would say also Hong Kong has a major role to play with regard to the Belt and Road Initiative. We've seen Hong Kong issue at least 13 green bonds in the first 5 months of this year alone, culminating in around $5 billion US dollars. So further issuances of green bonds will play a role in supporting and unlocking capital towards the China Belt and Road Initiative.
Yes, and I would like to also respond to the second part of an earlier question in relation to the efficacy that SFI would engage in. As Leonie already talked about, our first year was very much focused on working with private investors in Hong Kong, building a community of active private investors, but we will be participating in different platforms, working with other stakeholders in Hong Kong to continue that dialogue with the government, hoping to engage them on the policy side of changes.
Great, thank you, Leonie and Tze-Wei. Peter and Ronnie, would you like to share with us your view on this?
I'm sorry, I couldn't quite hear that question. If somebody doesn't mind repeating it.
The question is, what about Hong Kong as a gateway for sustainable investment in China, and what is the state of the sector in China?
Yeah, that's a big question. But I think Hong Kong generally is for decades really seen as relatively innovative in terms of financing, trading, simply because of the maturity of its relative maturity of the stock market. But there's no question in my mind that given the size of the Chinese market, there's the relative sophistication of the investors. It's still quite a retail-based market compared to relative to Hong Kong, I would say generally. But no, I think yes. That certainly Chinese can learn a lot from sustainable finance in Hong Kong, but it's such a big market now that I do think any attempt at advocacy must treat China as almost like a separate destination or separate stakeholder to Hong Kong.
Great, thank you, Peter. Thank you everyone for your participation in this interesting session, and thank you very much to all of our speakers. If you have any further questions, please feel free to email us at china@avpn.asia. We will post the webinar recording on our website by next week. Please look out for it. Thank you, everyone. Have a great day.
Thank
Thank
you.
you.
Bye.
Thank you all. Bye bye.